Every serious investor calls U.S. Treasuries the safest asset on Earth. Every serious coder will tell you blockchains are the most dangerous laboratory ever built. So why are we wiring the world's safest asset into the riskiest machine? Why are government bonds, those sleepy coupons your grandfather clipped, showing up as tokens you can move at 3 in the morning on a Sunday? Here's the paradox. The more we make treasuries programmable, the less we can pretend money is simple. When bonds meet code, yield turns into software, and software always has edge cases. This is the markets and machines historian, where money, power, and history collide, and nothing is as simple as it looks. Debt isn't just a burden, it's the architecture of the modern world. And now that architecture is being refactored. The latest mutation is tokenized treasuries. Real-world government debt wrapped in smart contracts, traded like stablecoins, settled like messages, and plugged into a financial internet that never sleeps. If you follow the chain of claims long enough, you discover something unsettling. The promise didn't change, only the speed, the surface area, and who gets to plug into it did. And that changes everything. To see how we got here, rewind the clock. In 1694, the English crown needed money. It sold promises, bonds, backed by future taxes, and in exchange, it received the present it couldn't otherwise afford. Those IOUs became tradable, and the idea spread. The state could raise large sums, fight wars, build fleets, and knit an empire together by selling slices of its future. For centuries, those promises were paper. Then they were immobilized in vaults, and later dematerialized into entries at clearinghouses. DTCC, Euroclear, the alphabet soup you never see if you're not paid to stare at settlement screens. The promise stayed the same. Lend to the sovereign, receive interest, get your principal back at maturity. It's the plumbing that kept evolving. Tokenization is just the next turn of that wrench. It isn't a new asset, it's a new ledger. Instead of your ownership living in a transfer agent S database or a fund S omnibus account, a smart contract records it. The underlying bonds still sit in custody, inside a regulated fund or a special purpose vehicle with dull legal documents and duller trustees. But your claim on that bundle becomes a token, a receipt with teeth. It can move, split, lock, and interact with other code. In plain English, we didn't reinvent treasuries. We made their claims composable, like swapping a marble statue for a Lego sculpture, same silhouette, infinite ways to snap it into other structures. So what is a tokenized treasury in practice? Strip away the buzzwords. A legal entity holds government debt, short-term bills, notes, or a money market fund full of them. That entity issues digital shares and mirrors those shares as tokens on a blockchain. Off-chain law defines the rights. On-chain code enforces who can touch them and how. There's a gate. Most of these tokens live on whitelists. Pass KYC and AML, and your wallet gets the magic stamp that lets it hold and transfer. Fail the test, and the door is shut. There's an oracle. Yields, net asset value, and prices do not appear on-chain by divine inspiration. Someone, somewhere, pushes the numbers in, and there's a flow. You send dollars, or stablecoins representing dollars, to the issuer. Tokens arrive in your wallet. Over time, your balance accretes value, or you receive periodic payouts. When you redeem, tokens burn, and dollars flow back the old-fashioned way, through banks that still believe weekends are a thing. Why now? Because 3 forces converged. First, yields rose. When T-bills pay something non-trivial, idle cash stops being background noise and starts being an opportunity cost you can hear. Second, stablecoins created a dollar internet with its own gravity. Trillions move across crypto rails at all hours. Those dollars want yield without leaving the rails. Third, developers became the new operations teams. If collateral can be called like a function, deposit, pledge, rebalance, then code will call it. Historically, you waited for a fund window to open, filled out forms, and prayed the fax machine didn't jam. Now, a script sweeps balances into bills at 0117 UTC and reverses at 0122. The line between cash and collateral blurs. That's not marketing, that's mechanics. The promise of wrapping bonds in code is straightforward. Programmability is the first carrot. Risk rules become software rather than staff instructions. If balance exceeds X, route surplus to bills. If margin drops below Y, auto pledge. No memos, no sleepy Friday ops teams, just code that never forgets. Composability is the second. Your treasury exposure slots into lending pools, payment rails, and trading systems. The same dollar can be earning and available at least until the model collides with the fine print. Auditability is the third. On-chain transfers are traceable. That doesn't make the asset safer, but it makes the movement less mysterious. Interoperability is the fourth. You can wire exposure to a counterparty a continent away with the same ease as sending a message. Settlement becomes message passing, not a calendar appointment with a back office. And granularity is the fifth. You don't need institutional ticket sizes. You can hold 50 thrower. Just 40 taos of a fund share, roll it into a strategy, and actually see the flows happen in real time. But here is the illusion. Code wraps law, it does not replace it. Ultimate custody is off-chain. The SPV, the fund, the custodian, those are the hands touching the actual treasuries, not your wallet. If the entity is mismanaged, hacked, frozen, or simply slow, your beautifully auditable token can become a claim on a problem. Transfer freedom is conditional. Whitelists can pause. Admin keys can freeze. The chain may say you own it. The term sheet may say you don't, at least not if a regulator calls on a Tuesday. NAV is an oracle. If the rate feed breaks, the contract believes a fairy tale. You can be right economically and wrong mechanically, and the machine only speaks mechanics. Liquidity is a promise, not a property. Redemption windows, cutoff times, settlement banks, none of that vanishes because your wallet confirms in 5 seconds. A token that looks like cash can behave like gated fund paper the moment markets stress. None of this is conspiracy, it's policy. Tokenization moves the interface, not the jurisdiction. If you want to know where these systems break, start with stress. Smart contracts are precise up to the first bug. Paused contracts, frozen redemptions, upgrade keys controlled by a handful of people, governance votes hijacked by inattentive token holders. Exploits don't care that T-bills are safe. The wrapper can fail even if the core asset is pristine. Oracle drift is next. Picture a Friday close when yields gap and the oracle lags. One protocol prices your token at yesterday's level, another at today's. Arbitrage starts as a feature and ends as a bank run in milliseconds. Custody choke points lurk upstream. A frozen bank account or a flagged wire can cascade downstream into your instant token world. The token moves fine. The redemption pipe is a brick wall. Legal ambiguity adds another layer. Do you hold a security, a fund share, or an unsecured claim? In bankruptcy court, those nouns are not synonyms. Then there's the liquidity mismatch. On-chain everything looks instant. Off-chain. Everything comes with cutoffs. The gap between the two is where panic lives, and we haven't even touched the regulatory perimeter, where a new rule can reclassify the wrapper, restrict wallets by geography, or require surveillance hooks that turn permissionless paths into toll roads. Think of the system like a poker table. Every player has borrowed chips from the next. The game stays orderly because nobody stands up. Tokenized treasuries keep the game fast. They don't change that rule. As long as everyone believes redemptions will clear on Monday, Saturday looks liquid. Confidence is the asset. Speed is the accelerant. Now, zoom out to the monetary plumbing. Treasuries are the world's collateral of choice. In traditional markets, they grease repo, derivatives margin, and bank balance sheets. Wrap them in tokens and you don't create new collateral. You change how fast it circulates. Velocity goes up. If collateral can teleport between counterparties, leverage can scale faster than risk teams can blink. Opacity goes sideways. On-chain movements are visible. Off-chain obligations are not. A neat dashboard can hide a messy balance sheet, and policy implications balloon. A future crisis may require central banks to backstop not just banks and funds, but interfaces, oracles, custodians, and smart contracts that became too composable to fail. Fedwire was built for bankers' hours. Tokens don't sleep. When monetary policy meets continuous time markets, timing becomes a policy variable nobody voted on. There's also geopolitics, because there always is. Tokenized treasuries export the dollar's yield as an API. That strengthens the dollar's reach. A developer in Lagos or Lahore can build with risk-free rate exposure like it SA standard library import. The paradox is that the more programmable the dollar becomes, the more political the permissions become. Sanctions, whitelists, geofencing, code can embed state power as easily as it routes payments. Do tokenized treasuries dollarize the planet further, or do they ring-fence it more tightly? The answer is yes. Consider a Friday night thought experiment. It's 4:58 p.m. in New York. A surprise data print jumps yields. A popular tokenized bill fund doesn't update the NAV oracle until Saturday evening UTC. A DeFi lending pool still values the token at yesterday's price. Traders borrow against yesterday's dollars, lever up into something spicy, and go to bed. By morning, oracles catch up. Loan health flips from safe to liquidate. Gas fees spike. Redemptions queue. Whitelists strain. A custodian flags a large outbound wire for manual review on Monday. On-chain, it looks like code doing math. Off-chain, it's humans doing Mondays. Who backstops the gap? Not the bond market. The treasuries are fine. Not the blockchain. It did what it was told. The backstop is whoever sits beneath the wrapper and whether they planned for internet speed runs on banking hour rails. So who actually wins in this brave new wrapper world? Issuers and sponsors will say we modernized markets. They also collect fees on the same asset with a better user experience. Not villains, just toll collectors. Market makers and integrators will find spreads in the cracks, tokenized bills versus bank bills, on-chain repo versus off-chain repo, basis trades that hum quietly until they don't. Developers gain a new primitive. They can treat the risk-free rate as code. The best ones will build safety rails. The worst will build lasers pointed at their feet. Institutions with compliance muscle win because whitelists are porous to some and concrete to others. If your lawyer answers faster than your competitors, you move first. Retail sometimes wins, sometimes doesn't. By design, many of these wrappers exclude small investors. Others include them through wrappers on wrappers. When it works, they get yield with fewer hoops. When it breaks, they learn the hoops weren't gone. They were invisible. How should you think about all this? Mechanically, not morally. Follow the claim. Who owes you what? Through which entity? Under which law? If you can't draw that chain on one page, you're not investing. You're hoping. Map the kill switches. Who can pause the contract, freeze the allow list, change the oracle? Power you don't see is power you don't price. Assume time mismatch. Your token is instant. Your redemption is not. Model queues, not just balances. Diversify the primitives. If everything depends on the same oracle, you don't have diversification, you have decorations. And read the boring bits. The most dangerous lines live in footnotes. Issuer may gate redemptions. Sponsor may amend terms. Regulatory changes may impact availability. May means will, eventually, because history says so. What's the bigger picture? Debt is turning into software. We used to say cash is king. Then we learned collateral is king. Now, interfaces are kingmakers. Tokenized treasuries make the risk-free rate callable like a function. That's not just convenience. That is a shift in how the financial system thinks, from batching and cutoffs to event-driven money. Every time we accelerate finance, we accelerate its failures. The telegraph birthed instant runs. ETFs birthed intraday panics. Tokenized treasuries will create something new, runs that start in code and end in court. None of this means we should slam the brakes. It means we should learn the handling before we floor the accelerator. There's an older lesson hiding underneath the shiny surface. Debt is a promise. Promises are social before they are technical. They work because enough people believe they will work tomorrow. When we move those promises into code, we don't magically immunize them from doubt. We just make the doubts propagate at network speed. A rumor that once took days to infect a market can now find 1,000 automated listeners in seconds. A basis, mispricing that once died in a back office, now routes through bots that never blink. Confidence remains the real collateral. Code just tightens the feedback loop. If you spend your days inside the traditional system, tokenization looks like a cost reducer. Fewer faxes, fewer manual reconciliations, fewer cut-off emails. If you live in crypto, it looks like a new primitive. Real yield you can compose with strategies that used to sit behind velvet ropes. Both are true, and both are incomplete. The full picture is that we're merging two cultures with opposite defaults. The bond world assumes control first, openness later. The code world assumes openness first, control later. Tokenized treasuries are an uneasy truce. Whitelists coexist with wallets. Admin keys sit beside public explorers. Instant settlement rubs against Monday morning wires. The frictions don't disappear, they migrate. What should keep people up at night is not the headline risk of the US government reneging. It's the operational reality of bridging two clocks. Markets built on continuous time, wrapped around institutions built on batch time. A world where leverage can escalate in seconds and redemptions can't. Where a governance vote can pause a contract but not a rumor. Where every improvement in UX hides an equal and opposite increase in dependence on whoever writes the oracle. The optimist case is worth hearing. The more we program safe assets, the more we democratize efficient cash management, the more we reduce slippage and fees and human error. Global entrepreneurs can build dollar-native products in places where banks fear to tread. Payroll can earn yield until the hour it's paid. Treasury operations that took teams can become scripts. The pessimist's case is also worth hearing. The more we program safe assets, the more we invite reflex loops. The more we concentrate power in the hands that control lists and feeds, the more we risk discovering that the wrapper, not the bond, was the weakest link. Both views are correct. The question isn't whether tokenized treasuries are good or bad. The question is whether we understand their true nature. They don't change what a treasury is. They change who can touch it, how fast it moves, and how far the shock travels when something slips. The plumbing is the story. The story is about confidence, and confidence is about time. How long it takes to move a dollar, change a rule, push an update, or pick up the phone when Monday finally arrives. Politicians will say we modernized markets. Issuers will say we democratized yield. Coders will say we unlocked composability. They'll all be right. But the goal has never been to eliminate risk. It's to keep it serviceable, sellable, and fast enough that the system never stops believing. Tokenized treasuries won't make the world safer by decree. They will make it faster by design, and speed turns small cracks into big headlines when the weather changes. When bonds meet code, debt stops being paper and becomes a protocol. The benefits are real. So are the edge cases. The safest asset on Earth now lives inside the riskiest machine we've ever built. Maybe that's progress. Maybe it's just history in a new interface. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.